All right, good evening, ladies and gentlemen. Welcome to Stock Investing for Complete Beginners. My name is June Collier. I am your coach today, your instructor. It is November 6th. We are on week number 2 for your stock training class. So let's go over a couple of things that we had this week. Last week, we talked about terminology. We talked about understanding what words mean. It's important that you understand what words mean in order for you to be able to understand how to trade stocks. Got to know the language before you actually get out there and start trading. And so what I want to do is I want to share with you some ways that you can get access to all of the information, because some of you may need to go back and refresh some of the information. Some of you may have missed the first week and you want to go back and get that information. The link that I'm going to drop in the chat right now, I want everyone to get that link and save it somewhere, because that is the link that's going to have all of your documentation throughout the week. Matter of fact, let me go ahead and share my screen so you can see what that is. And let's do this real quick. Let's go here. Paste that link. Let me go grab that link so that you'll know what that link looks like. So when you go to that link that I just dropped in the chat, you're going to go to a folder on Google, and that folder is going to be for fall 2023 class. And inside of that folder, you're going to see week number 1. Inside of week number 1, I've given you all of the documentation that you need for the week. So not only did I do it, and I did it in alphabetical order. So A, B, C, D, and then the quiz. So you know to watch or to look at this first, to look at this second, third, and then fourth. So all you got to do is just go in here. These are PDFs. You can print these out and put it in a 3-ring binder. I definitely recommend that because it's easier for me to learn when I've got something physical. But for those of you who just want to look at it and read it online using your computer or using your phone, you can do that. All of these are PDFs, and they go over all of the materials. So again, number C is going to be the presentation that I did last week. Thought I had the talking points on that one. I guess I didn't. So I'll get the talking points on that one so that you guys can see the talking points. Because normally what I like to do is when we do the presentation, you'll get the talking points. So each week you'll have the information. You'll come down here to number D. And if we click on D, you'll see that there's this big video icon here. This gives you all of the videos that we've covered. So I gave you stock market terminology part 1 and 2. Those videos are there. And then the live training hosted on YouTube. So if you want to stay on YouTube and watch the training from last week, you can go there. Or some of you may want to look at what was in the chat, and you can go to this link, and it's hosted on Zoom. So the live trainings, these 2 videos are basically the same. It's just that one is hosted on YouTube, the other one is hosted on Zoom, in case you want to go back and look at the chat. Okay? So all of that information is there in that folder. And as we go along throughout the next several weeks, each week we'll have a new folder and there'll be information in that folder. So for example, we're in week 2. I've already put some information here in the folder. After tonight, I'll be putting some more information. Anything that I need to share throughout the week will be in week 2 folder, and then we'll jump into week 3. All right. So hopefully everybody understand how that works. That's why that link is very, very important. All right. Good stuff. All right. Somebody says, I don't see the link in the chat. Can you send it again? All right. So here's what we'll do. We'll get that over to you guys. I think what ends up happening is if you arrive a tad bit later, all of the links that I shared in the past earlier that day may not necessarily show up. So we're going to show this one more time, and then we're going to move on to the rest of our training. I will drop this throughout the training as we go along. So there's the link again. That's the link that everybody needs to have in order to take advantage of the training. All right. The second thing that I like to do is I like to give quizzes to make sure that you have grasped all of the information. And so you'll find the quizzes in the folders. I have not created the quiz for week number 2. So you can go back to the folder probably around Thursday or Friday. I usually have created the quiz at that time, and you can go and take the quiz to just see that you are up to date on the information for that particular week. I also drop that information inside of our Facebook group. If you have not been invited to the Facebook group, I definitely recommend that you join the Facebook group, and you'll just need to contact me on Facebook, and I'll let you in that group. So let's go over the quiz for the week, and let's just come here and just kind of see what the quiz is all about. So each week you'll get quiz questions. This week we have 25 questions that you should know. So we're going to go straight through this. Which of the following is a share of ownership in a company? A share of ownership in the company is a stock. That is a share of ownership in the company. And I just realized that because it's my quiz, I can't click on it like I normally do. So it's the stock, all right? Which of the following is a person who owns stock in a company? So this is a person that actually owns stock in a company, and we call that person a shareholder. Shareholders actually own stock in the company. Which of the following is a loan to a company or government that pays interest at regular intervals? So remember, I told you that you can either buy stocks or you can loan money to companies and to governments. So when we loan money, that's known as a bond. That is a bond when you loan money, okay? I don't know why this is checked here. I got to go back and fix that. Next one. Which of the following is a payment made to shareholders out of a company's profits? That is known as dividends. So when a company pays you out of their profits, they're actually paying a dividend. Next question. What's the highest stock price a stock can be purchased at and still considered a penny stock? What's the highest amount that you can spend on a stock and it still be considered a penny stock? The answer is $5. So anything that's $5 or below is considered a penny stock. Which of the following is a unique identifier for a stock? So we know that sometimes it's a 1-letter abbreviation, 2, 3, or 4-letter abbreviation, and that is known as the ticker symbol. The ticker symbol is the abbreviation that you come across to see what the stock is. Here's one that I was worried that people might not get this one. Which of the following is a type of stock that has voting rights and the potential to earn dividends? And that is known as common stock. Remember, there were 2 different types of stocks. There was common stock and preferred stock. Common stock allows you to vote and get possible dividends. When we come down here to the next question, which of the following is a type of stock that does not have voting rights, but typically has higher preferences for dividends? And that's going to be your preferred stock. Next one, which of the following is an increase in the value of an investment? So when I say that you have capital gains or capital appreciation, what that means is you bought the stock for $50, is now selling at $60, you sell it at $60. Those are called capital gains, that $10 gain, okay? Now, you want to know about capital gains because that's what you have to pay taxes on. So if I bought the stock at 50, I sold it at 60, I got $10 worth of capital gains, I'm going to have to pay taxes on that. And you can pay long-term taxes, or, well, there's something called short-term capital gains and long-term capital gains, and that will determine how much you pay taxes on. We'll talk about those a little bit later taxes, but that's known as capital gains. Next one, which of the following is the ownership interest in a company? The ownership interest in a company. And this is known as equity. So anytime someone says, I've got some equities, what that basically means is they have ownership in a company, an equity. This is equity, okay? Which is the following is the first time a company sells its shares to the public? The very first time the company sells its shares to the public is called initial public offering, IPO. Next one. Which of the following is a stock market index that tracks the 30 largest publicly traded companies in the United States? That is known as the Dow. They track the top 30, the Dow. Which of the following stock market indexes track the 500 largest publicly traded companies? Well, that's pretty easy. That's known as the S&P 500. Which of the following stock market indexes track the largest publicly traded technology companies? That is known as the NASDAQ. And remember, I gave you guys an extra bonus on this. Who created the NASDAQ? And that was Bernie Madoff. Bernie Madoff actually created the NASDAQ. Which of the following is the total value of a company's outstanding shares? That is known as market cap or market capitalization, right? That's the total amount. You take whatever the cost per share is, and then you multiply that times the number of shares that that company has, and that will give you that company's market capitalization, all right? So if you had 1,000 shares in your pizza company and they were selling for $100 each, your market capitalization for that pizza company would be $100,000, okay? Which of the following is a period of time when stock prices are generally rising? We call that the bull market. And remember, when a bull charges or a bull attacks, he attacks by his head is down and then he raises his head up. So that's why they call it the bull market, because when the bull attacks, he's raising his head up to attack. Which of the following periods is a time when prices are generally falling? That's known as the bear market, because when a bear attacks, he starts up here and he swings down. That's the bear market, right? Now, this is the one that Ms. Siebels was asking about. Which type of analyst or analysis examines a company's financial statements to assess its value? We're going to be talking about this in a few weeks, but we're going to be talking about fundamental analysis. So the fundamentals looks at the numbers of a company. How much debt are they in? How much do they pay in dividends? What's their top line revenue? What's their bottom line revenue? How many shares do they have, and what are they paying in dividends? So it's all about the numbers. That's called fundamental analysis. Technical analysis, I don't think I did a question on technical analysis, but technical analysis tracks the mood of the market. Like it's more chart reading, where you read the charts and one line is crossing over another line. That is technical analysis. Which of the following is the largest stock exchange in the world by market cap? That would be the New York Stock Exchange. And we got a few more. True or false? A stock is a loan to a company or government. Well, we know that that's false, because a stock is not a loan. A bond is a loan. True or false? A dividend is a payment made to shareholders out of a company's profits. True. Dividend is a share of their profits. True or false? Over-the-counter trading is a decentralized market where stocks are traded directly between buyers and sellers. That is true. So remember, we got penny stocks, and this is a market that's not heavily regulated like the New York Stock Exchange or the American Stock Exchange or the NASDAQ. There's heavy regulations there. But for your penny stocks, a lot of those stocks are traded over the counter, and it's between you and the company, and there's not as much regulation that's there. Okay, so that is true. Technical analysis examines the historical price and volume data to identify patterns that may predict future price movements. This is true. So when you're looking at technical analysis, you're looking at patterns. Last two, preferred stock has voting rights, but typically has lower preference for dividends. Okay. Well, we know that preferred stock does not have voting rights. So this is going to be false. And then finally, market cap. Market capitalization is the total value of a company's outstanding shares. That is true. Okay. All right. So that's the quiz for week number 1. Even if you sit here and you didn't go through the quiz, I recommend you go back through the quiz and answer those questions. It is very, very important. I see some of you were answering the questions as I was calling them out. Good, good, good. Love it, love it, love it. So let's jump into week number 2. We'll jump into week number 2. And let's talk about the 7 stock category classifications. So this is very important because this is going to help you determine what stocks that you might be interested in buying based on your personal situation, based on the economy, and a lot of other different things. So there are great times to buy a stock, and then there are bad times to buy certain stocks. And we're going to put these stocks in different category classifications. The goal of our course here tonight is to teach you what the 7 stock category classifications are. And upon completing this course, you're going to understand each stock classification. All right, so there's 7 of them. Let's cover the first one that most people have heard of before, but maybe you never understood, and that's called a blue chip stock. Blue chip, okay? These are going to be large, stable companies that are continually profitable. Now, here's the thing about blue chips. You're not going to see a blue chip stock move like a growth stock. And we'll talk about growth here in a moment. But a blue chip is a very large company. They're making profit. They're not going to be jumping through the roof. They're not going to do 20%, 30%, 50% for the year. But they're a tried and true company. These stocks are expensive, but they provide the lowest risk, and they have an established track record for earnings. Now, when I first started trading stocks, you guys know I told you about my penny stock fiasco. When I got back into the stock market the second time, I took it a little bit more serious, and I said, I don't like losing money. I'm going to put my money where the big boys play, and I'm going to put my money where I have the lowest risk, and that was blue chip companies. All right. So blue chip companies are very well established. They've been around for quite some time. Most of your Dow 30, if not all of them, are blue chip companies. So in the chat, what do you think of some blue chip companies out there? Just go ahead and type in some companies that you think are blue chip companies in the chat. And while we do that, I'm going to go here to Google. And I want to get a list of the Dow 30. Okay. So whatever you think is, let's take a look at the chat. Let's see what you guys think. Some say Amazon, Google, Walmart, Ford, Lowe's, Home Depot. Okay. So we can only have 30 now. There's only 30 of them. Alphabet, Tesla. So S&P is not a blue chip. S&P is an index. So that's an index of multiple companies in one. Somebody says Verizon, GM, Home Depot, Apple, Microsoft, 3M. Okay, all right. So let's take a look at the Dow 30. And these are going to give you the top 30 companies. All of these are going to be blue chip. So let's just take a look at them. And I want you to know what these are, because if you're out looking at investing, you need to know who the big boys are, right? So these are the big boys, and these are the guys that I started investing in when I came back into investing. So American Express, I have American Express. I own some American Express today. Amgen, Apple, I own some Apple. Boeing. Boeing is an interesting company because they make big jets. They make the planes that you fly in, right? And there's really not a whole lot of companies that do that. You know, you got Boeing, you got Airbus, and maybe there's one other. Caterpillar. Caterpillar is those big yellow tractors that we see that build highways and construction and all of that. Cisco, Chevron, Goldman Sachs, Home Depot, Honeywell, IBM, Intel, Johnson & Johnson, Coca-Cola, JP Morgan, McDonald's, 3M, Merck, Microsoft, Nike, Procter & Gamble, Travelers, United Health Group, Salesforce, Verizon, Visa, Walgreens, Walmart, Disney, and there is a company called Dow. It's a chemical company, okay? So these are the top 30 companies that are in the Dow. These are going to be blue chip companies. They're so big that they just don't move fast like other stocks will move, but they usually pay great dividends and they usually make decent money, okay? So if you don't like to lose money like me, and you like to keep your money in your pocket, but you like to advance your money, then I would start off by looking at 30 companies. Now, here's what the mentality was for me. I think there's like 8,000 publicly traded companies out there. Who has the time to go through that many? So I said, I'm going to go through the 30. And so out of the 30, and you don't have to, this is not an endorsement for any of these, but I got American Express, Apple, Home Depot. I don't have Home Depot right now, but a couple of years ago, I was trading Home Depot, really great company. I haven't done Coca-Cola, but that's a solid company. I haven't done McDonald's. They've been doing really well. I don't know who's eating at McDonald's, but the stock is doing well. Microsoft, you guys know that's Bay. That's Microsoft is Bay. I own Nike. Visa, I've traded Visa. I trade Walt Disney. I own Walt Disney. And I've traded Walmart in the past. So probably out of the 30 here, I've bought and traded maybe 15 of these. This is something that I'm telling you to look at very, very seriously because these are going to be stable companies. Now, we don't worry about the price. You're going to make a big mistake if you buy stock based on how much it is per share. You may say, well, June, I only have $1,000. Why would I buy Microsoft or Goldman Sachs at $323? Let me go get this $10 stock. That stock is $10 for a reason. I'm going to say this until I'm blue in the face. We don't buy quantity, we buy quality. All right? And we'll talk about that a little bit later. But this is blue chip. Those are blue chip stocks. All right, let's get into our second category. Before I move on to that, blue chip stocks usually pay some great dividends. So if you want some good dividends, blue chip stocks usually pay great dividends. So for example, let me explain to you dividends real quick. We're going to go over here to Yahoo Finance. And you can see if a company is paying dividends. So we'll go to Yahoo Finance. Let's take a look at Home Depot HD. We'll do our search. We'll see that Home Depot is traded on the New York Stock Exchange. And what we're going to look at is we're going to look at right here where it says forward dividend yield. So Home Depot pays $8.36 a share per year on the stock. which is roughly 2.8% of what the current price of the stock is. Okay. So Home Depot pays out on a quarterly basis. So that what that means is every quarter, once a quarter, when Home Depot pays its dividends, 836 divided by 4, you're going to get $2.09 every time Home Depot pays out dividends. So if you had 1,000 shares of Home Depot, every quarter you make $2,900, right? You make $2,900 if you had 1,000 shares of Home Depot. Let's take a look at, and this percentage tells me the yield. That's just the how much they're paying on that share of stock. If we go to Coca-Cola, which is KO, we can take a look at this company as well. Coca-Cola is $56. It pays $1.84, which is about 3.2%. So if you're in retirement and you want a steady check that's coming in, you want a stock that's not going to move around a lot, that's pretty steady, and you just want to get those dividends, you could get a 3% dividend yield on a company like Coca-Cola. All right. All right. So that's just an example. And so we'll see Coca-Cola right up here. It says Coca-Cola announced a cash dividend of 46 cents with an X date of November 30th, 2023. So let's explain what that means. First of all, 46 cents. Well, June, I thought you said $1.84. Well, remember, you got 4 quarters. So they pay once a quarter. So we got to take this $1.84 and divide it by 4. And we'll see 46 cents. So 46 cents a quarter. So we can see the 46 cents there. That's where that comes from. Okay. So if you have 1,000 shares, 1,000 shares of this stock, where's my 0 at? You're going to make $460 once a quarter, every quarter. Okay. Now, what is this X date, November 30th? So what that basically means is that you must own shares of Coca-Cola by November 30th. Okay. So you have to own Coca-Cola by November 30th in order for you to get the dividend of 46 cents. So if you buy it on December 1st, you missed out. You got to own the shares on November 30th, by November 30th. That's what that means. Okay. And we'll talk a little bit more about that when we get into dividends. All right. Let's go back to our second category. Second category is speculative stocks. So what do we mean by speculative? Well, the image should show you what speculative is. You're walking a tightrope. These are startup companies. These are brand new companies with very little financial history. These companies often develop new and untested products. They explore untapped markets. It comes with a high amount of risk, but it also has the potential to get huge returns, and that's what makes them appealing to some investors. So this is going to be your penny stocks. This is going to be companies that just really got started, your IPOs, your initial public offering stocks. These are going to be companies in emerging markets. So these are going to be just new companies. And I would tell you to probably stay away from these companies. Okay? If you like your money. Now, if you like to gamble, and you like going and playing at the horse track, and you like buying lottery tickets, then this is right down your alley. This is right down your alley if you love playing lottery tickets. But for me, speculative investing was not something that I wanted to do. Okay, so I don't buy IPOs. Here's why. It says startup companies with little financial history. So when you're a private company, you don't have to share your numbers. Once you become public, you have to share your numbers. But if you're an IPO and this is the first time that you're being brought out to the public, I don't know your numbers. I gotta wait until you've been on the market for a little while to be able to see your track record, right? I gotta see your track record over a period of time. So IPOs, initial public offering companies, would be speculative companies. Okay. Now there's one company that I would purchase as an IPO. That's Chick-fil-A. If Chick-fil-A ever went public, I would purchase Chick-fil-A as an IPO. I don't know what their numbers are, but I know what I see when I go to Chick-fil-A. I would probably purchase some Chick-fil-A speculative stock. Okay. Now let's talk about the next one, which is pretty exciting. This is where you can earn some good money, especially if you're young. So if I'm older, I'm going to stick with the blue chip because I don't have time to be wrong about my investments. But if I'm younger, I'm in my 20s, my 30s, maybe even my early 40s, I may get some growth stocks. Now, growth stocks are issued by companies that are expected to have high earnings, but the earnings are reinvested into the business. So growth companies don't pay dividends. They don't pay dividends. They take all the money that they have earned and they invest it back into the company. So what you'll see is you'll see the stock price go up or drop, all right? You'll see the stock price go up, but the company does not pay dividends because it's taking all of their earnings and they're reinvesting those earnings back into their company. They're reinvesting into research and development, those types of things, okay? Now, let's talk about a couple of growth stocks that are out there. This is going to be crazy because these growth stocks that I'm going to name are also blue chip stocks. Normally, blue chip stocks are not reinvesting. So, for example, Coca-Cola. Coca-Cola ain't got nothing to invest in. You can go to Africa and get Coca-Cola. You can go to China and get Coca-Cola. Coca-Cola has expanded all over the world, and it really has nothing else to do, no other places to grow, because you can buy a Coke anywhere. So whenever we start, populating Mars and Coca-Cola goes to Mars, then we might see them as a growth company. But here's some companies that I thought were pretty interesting that are also blue chip companies. Matter of fact, before I list out some of these companies, what companies do you think are growth companies? What companies do you think are reinvesting back into themselves? Ann says Amazon. That's the first one on my list. Apple. Yep, Apple's on my list as well. James says Microsoft. Tesla. Yes, you guys are looking at my list. I don't know about Dell. I don't think Home Depot is not on that list either. Okay, so let me give you a few companies that are reinvesting. Definitely not Procter & Gamble. Procter & Gamble is not reinvesting heavily in their business. They are well established. Let me give you some companies. We got Amazon. Amazon is constantly growing. They're constantly expanding. They're putting money back into their business. Microsoft. We saw Microsoft put money into AI this year. ChatGPT. Microsoft gave them like $10 billion. That's big time. Alphabet, which is Google. We got Meta, which is Facebook. We got Tesla. We see Tesla reinvesting constantly. Shopify, Etsy, Netflix. All of these companies would be what we consider growth companies. And this is where you're going to get the largest jump in your stock price, because these companies are reinvesting in themselves and they're taking a lot of their earnings, putting it back into research and development, putting it back into new products, and they're growing. And you'll see that stock jump. You'll see that stock run. That's called a growth company, okay? Because they reinvest back into their company. Now, why am I telling you this? Because when we get to the week where we start talking about fundamental analysis, well, in the fundamentals or in the financials, you're going to see where companies are putting money back into research and development. You're going to see where they're investing. So you can see the companies that are investing. You can see the companies that are putting money back into themselves. Those are going to be growth companies. Okay. Microsoft happens to be very unique. Amazon, Alphabet, all of them are unique because they're both blue chip and they're reinvesting and they pay dividends. So they're very, very unique companies. So here's something, hint, hint. You got to like a company that's a blue chip and also considered growth. You got to love that. Hint, hint, right? Find those companies that are both blue chip and growth. Those are great companies to be looking at. All right. All right, let's move on to category number 4. Hopefully this is starting to make sense to you as it relates to what you want to look at. Now, value stocks. This is where Warren Buffett loves to play. Warren Buffett plays in this playground. Value stocks are stocks that are viewed as undervalued, but there's potential there. Usually something has happened in the company that can be fixed, or something temporarily that makes the company drop. And you'll get a guy like Warren Buffett that'll buy up so much, and then they'll go in and they'll replace management. So usually they may have a good product, they may have a good industry that they're in, but they got bad management. They got a horrible CEO or just bad management. And you'll see guys like Warren Buffett that'll come in and they'll put $1 billion on that company. And then all of a sudden the CEO is fired. They bring in a new CEO. They do this, they do that. And that stock starts to take off. I'll give you a company that recently hired a new CEO and she's killing it. She's doing phenomenal. And that's UPS. So UPS was a good old boys network. And for the longest they ran business the good old boy way. And then this female comes in, and I forget where she came from. She came from another high profile company, and she came into UPS and she started changing stuff around. She started breaking down the good old boy network inside of UPS. Now, how do I know this? I got a friend that works at UPS, and he's telling me about all of these changes that's starting to happen in the business. And I said, you better buy some stock. Carol Toomey, yeah, from Home Depot. There we go. I said, you better buy some stock in UPS. And she has really been turning UPS around, making some major changes and different things. And there's a lot of people that left. Of course, when you got new leadership, either people leave by choice or they leave by force. And the company is really starting to make a shift. And so that would be what we would consider a value company. Another value stock that you might find is some bad news happens to a company, but it's temporary. I'll give you an example. Many years ago, probably 8 years ago, there was an incident that happened on, I think it was United Airlines. There was an Asian guy that got pulled off the plane. And when I say pulled off, they physically dragged him off the plane. And he was screaming and hollering and all of that good stuff. And of course, people on the plane were videotaping it. And the airline company went down the next day. The price of their stock dropped because of bad publicity. Now, truth be told, it was the police or the security that was pulling the guy off the plane, not somebody from United Airlines. But of course, United Airlines, the stock dropped. And I think it dropped 10% for nothing, just because bad news, right? That didn't have anything to do with their financials. It had nothing to do with anything that really made a difference. And so because I saw that, I went in and I purchased some stock in United. I actually purchased an option in United because here's what I said. I said, Americans will forget about this in 3 to 4 months. And they'll be flying back again. They'll continue to fly with American Airlines or United Airlines. And it didn't take a month. It didn't take a month and the stock was back to where it was. So it dropped 10% off of some bad publicity, and then it was back up within 30 days. So those are the types of things that you're looking for when you look at a value stock. You're looking at a company that looks like a bargain deal, and you go in and you purchase that stock. Warren Buffett is a master at this. You and I probably are not as good at mastering that, but anytime something of major announcement happens to a company and it's not something that's critical that's going to knock them out, but the stock is going to drop because of the feelings, because the stock market is emotional. Short term, it's emotional. Look at that company's stock when the news comes out, and then watch that company's stock over the next month or two to see if that stock doesn't rebound. Okay, it's just emotional, and so that's what's called a value stock. So if God forbid somebody went to Six Flags and one of the roller coasters ran off the track, the stock's going to drop. But that doesn't necessarily mean that that stock's going to stay down. It's going to drop. You know, they're going to fix whatever they need to fix. It'll stay down for a little while, and then people tend to forget, and they'll go back to going to Six Flags and enjoying themselves, and the stock will come right back. Those are what we consider value stocks, and you can anticipate value stocks when you see something in the market that's happening. This is why the news, paying attention to the news, is extremely important when we're dealing with looking for value stocks. Hopefully that makes sense. All right, let's look at number 5. Number 5 is called income stocks. Now, if you are getting ready to retire, what do you want? You want some income, right? You want some income. And what does income mean? It simply means that these are stocks that pay dividends. Now, I'm going to share something with you. Most of your blue chip stocks are going to pay dividends because they're well-established companies. They take a portion of their earnings and they pay dividends. Name some dividend-paying companies out there that we've already talked about. Anybody know some dividend companies that we already talked about? How about a dividend company that's a blue chip company and a growth company, and now it's an income company? Somebody says Coca-Cola. Okay, Microsoft. There we go, James. Now I want you guys to think about that for a moment, because y'all know I talk about Microsoft all the time. Apple is also one, but I talk about Microsoft all the time because Microsoft is blue chip. Microsoft is also reinvesting a portion of their profits. So Microsoft is a growth stock company. And now we know that Microsoft also pays dividends, which makes it an income category. So far, out of the 5 that we've looked at, Microsoft is in 3 of those categories. So when you start looking at these stocks and the stocks that you want to invest in, ask yourself, what categories are these stocks in? If you are at a point where you're getting ready to retire, you want an income stock. So you may want a stock like AT&T or Verizon that pays a really significant amount of dividends, a dividend yield. So your average stock that's paying out dividends 2-3%, right? But when you get a stock that pays 5-6% in dividends, that's considered really, really good. So let's take a look at some of these stocks that actually pay really good dividends. What stocks can you think of that pay really great dividends? Let me go back here. Income stocks. So here's what we're going to do. We can see Coca-Cola is paying 3.2%. That's cute. That's nice, right? But we can go to a stock like AT&T, ticker symbol T, and you can see that AT&T pays almost 7% dividend yield. So for every $15 that you spend, you get $1.11 back in dividends for the year. Okay, so it's very easy for you to say, if I had 1,000 or 2,000 shares of AT&T, 2,000 shares is going to pay me well over $2,000 a year in dividends, and I never have to sell the stock. See, that's the power of dividends, is that I can make money and never get rid of the stock itself. That's the beauty of income stocks, is you can make money on the stock and never get rid of the stock. It's almost like having an apple orchard. You're able to have apple trees, and you're able to generate apples and live off the apples without cutting the tree down. Like, when would you ever cut the tree down for firewood? If you had an apple orchard, when do you cut the tree down for firewood? Never. You live off the apples, and you take the apples and sell the apples and buy some firewood, but you never cut your apple tree down, because it's an income producing asset. So when we talk about income stocks, these are going to be stocks like AT&T is paying a great dividend, 6.9%. That's steady, right? Let's take a look at Verizon, VZ. I don't know if there is pay out as much as Apple or as AT&T. So we take Verizon, the Verizon paying out more, 7.38%, right? So now we got to start thinking, okay, this company is paying out 7% in dividends. So what? The stock stays around $35. It ain't gonna go to 50. It's gonna be around 30 to 40, and that's where it's gonna be at. But you're not worried about that if you're getting paid dividends. Okay, so that's why it depends on your circumstance, because maybe you're in retirement and what you want is, I want to have income that happens on a consistent basis that I can depend on, and I don't really necessarily care too much about the fluctuation of the stock, because Verizon is probably going to fluctuate $10 one side or the other, 25 to 45. It's just going to kind of fluctuate right in that zone, but it's going to pay out dividends. So you're not concerned about, I won't say you're not concerned, but you're more concerned with the dividends than you are necessarily the day-to-day price of the stock. I hope that makes sense. I hope I'm making sense to everybody, okay? Now, what are some other companies that would pay you some dividends? There are companies that are called REITs, and this is not necessarily the stock market, but we're going to talk about REITs real quick, which are real estate trust companies. And I'm going to put down, here's a good one, American Tower. Anybody know what American Tower does? American Tower. Anybody know what American Tower does? The company American Tower? Type in the chat if you know what American Tower does. Somebody said toilets. Office buildings. Nope, none of that. Wireless, exactly. So American Tower, they build these towers, so when you're driving and you are making a phone call, your phone call connects. Anybody ever seen those towers, those things that look like trees but they're really antennas? This is American Tower. Now, I got one of my classmates here from back home, Mr. Kalinsky, and so he'll know what I'm talking about. Kalinsky, you know where I grew up. You know, I grew up in that White House up on the hill. You know, my grandparents were in the brick house, and then right up across the hill, I grew up in the White House. Well, almost diagonally across the street from my mom and dad's house is a tower. It's a big tower, and that little bit of land that's there is owned by American Tower. Matter of fact, because, and the reason why I know this is because last year I was doing some work with my parents, and I was trying to figure out what we're going to do with all this land that we have, besides just cutting the trees down every 30 years, right? What else can we do? And so I started researching that I could actually rent the land out to companies like American Tower. and American Tower would pay me rent money to have their tower on our land. So I got to looking around and come to find out they already had a tower directly across, almost diagonally across from where I grew up, right? You might know Kalinsky, you know Wiley Williams. The tower is behind where he grew up, the houses that he grew up on, right? Is owned by American Tower. Because I did the research and I saw the tower back there, and then I went online to look at who owned that land, and American Tower had actually purchased that land, okay? But American Tower is a company that pays out dividends, okay? This is a real estate company, so they pay out dividends from a real estate standpoint. Now, there's some other real estate companies out there like Realty Income. We'll do Realty Income. And let me see if the ticker symbol actually comes up. Let me see. Realty. There we go. So they're O. Their ticker symbol is O. So they're $50 and they pay out 6% in dividend yield. Okay. So real estate companies that have shopping centers where your grocery stores are, your malls, those type of companies, you can invest in those companies and you get great dividends from those companies in the form of real estate dividends, okay? Energy companies, utility companies. You can look at companies like Duke Energy, okay? D-U-K, Duke Energy, all right? So Duke Energy pays out dividends, okay? So here we go. Duke announces a cash dividend of $1.02 with an ex-dividend date of November 16th. So you got to own that stock by November 16th to get the dividends. But let's take a look at their dividends. So they got a 4.5% dividend yield. Now, why am I telling you about these stocks? Southern Company, AT&T, Verizon, Chevron. These are companies, you're going to find that these are companies that also are companies that people almost can't live without. Like, who's going to get rid of their cell phone? Right? I know that there are homeless people that got cell phones. Right? Southern Company. They sell you electricity. Who's going to live without electricity? Who's going to live without gas to heat their home? So there are some products that are necessity. So you got to think about that as well. Scanner would be one as well, okay? A utility company, all right? All right, let's keep it moving. Ann says, is dividends paid regardless of whether the company makes a profit or not? So great question. So Ann, what companies try to do is they want to pay a little bit more each and every year, because we're going to talk about dividend aristocrats and dividend kings when we get to the dividend week. And this will make a little bit more sense. But we don't want to necessarily invest in a company that pays out high dividends, but they're not making a profit, because that's a combination for disaster, right? So yes, there are companies that pay dividends and may not necessarily be making a profit. Company like that was AT&T. AT&T was in financial trouble a few years back, and they lost their ranking as a dividend aristocrat. And we'll talk about that when we get to the week of dividends. But yes, there are companies that may pay out dividends even though they have not made a profit, but that is not a company that you want to be invested in. All right, great question. All right, let's get back to number 6 of our classification. Number 6 is called cyclical stocks. Cyclical stocks. These are stocks that are dependent on the health of the economy. During a strong economic times, the stocks will flourish. During tough economic times, they lose a substantial amount of value. So tell me, what kind of companies do you think are cyclical? They do really well when the economy is good. Anybody type in some companies that you can think of that might be cyclical that do really well when the economy is doing great. Okay. Not Walmart. Not Walmart. Okay, there we go. So James says cruise ships. So companies like Royal Caribbean, those companies or any travel companies, those companies may not do so well when the economy is down, people losing jobs, the unemployment is up high, people are not comfortable with spending money during the tough times. They're probably not going to invest or go on vacation. So travel. Someone said gas, but gas is not, look, you're going to use gas regardless. How are you going to get to work? How are you going to heat your home? So gas, you're going to use gas regardless. What we're talking about is when the economy is doing extremely well. Hotel industry, thank you. Yes. Car manufacturers. So now people are holding on to their cars a little bit longer. They're not buying brand new cars because the economy is tight. So they're not buying that Benz. They're not buying that BMW, right? They're not buying that $60,000 truck because the economy is soft, okay? Luxury items, Louis Vuitton. Louis Vuitton is traded on the New York Stock Exchange. However, Louis Vuitton also owns Hennessy. So Louis says, if y'all ain't buying Louis, I know y'all gonna buy something to drink. So they kind of balance themselves out. But you're right, luxury items, clothing stores, hotels, restaurants, depending on what types of clothing, right? Because we still got to have clothes to wear, but depending on the types of clothes, okay? Someone says the housing industry, not really, because we still got to have a place to stay. Entertainment. So here's what you also need to know, that cyclical stocks can work on the opposite too. So what do I mean by that? Well, if the economy is tight, nobody's buying a brand new car, I'm keeping my old car a little bit longer, what company do you think would do really well if I'm going to keep my car a little bit longer? Somebody type in a company that you think would do really well. There we go. There we go, Carrie. Now, Carrie, most people don't know what that is. So Carrie says AZO. For those of you who don't know, that's AutoZone. Okay. Mona Lisa says Pep Boys. Right. AutoZone, Pep Boys, Advanced Auto. All of those companies tend to do well when the economy is down because people are keeping their cars a little bit longer. And now I got to go over here and get me some parts for my car. Right. I'm going to shock you guys. What do you think the one share of AutoZone stock costs? What do you think? And don't cheat. Don't go out and look. But what do you think one share of AutoZone stock costs? I'm getting ready to shock you. What do you think one share of AutoZone stock actually costs? Mona Lisa says $250. Somebody says $20. Let's go take a look. AZO, which is AutoZone. Okay. I bet y'all didn't think AutoZone was $2,605 per share. $2,605 per share for one share of AutoZone. You better not sleep on AutoZone. Right? So when you see how the economy does, the economy is going to move, and there's going to be certain companies that do well in a soft economy. How about this one? We're going to look at dollar. Let me see. What is it? Is it Dollar General? So Dollar General, DG. DG is going to do really well when the market is soft. Dollar General. So I want you guys to start thinking about the economy, where the economy is, where the economy is headed. I want you to start thinking about, what kind of stock you actually want to purchase, right? That's important. So Terry says, how can AutoZone cost that much? Because Terry, and we're going to talk about this in a future week, AutoZone doesn't do a whole lot of stock splits. The only reason why, Dollar General is 119 is just because it's probably done some stock splits. So we'll talk about stock splits in a future training, but AutoZone just hasn't done any stock splits. Do you know how much Microsoft would cost if Microsoft had never done any stock splits? It would be like Warren Buffett's company, right? Anybody know Warren Buffett's company? What's his company called? Berkshire Hathaway, right? So Warren Buffett has Berkshire Hathaway A and Berkshire Hathaway B. Now, I own some Berkshire Hathaway, but I only own the B class. I don't own the A class. But let's take a look at Berkshire Hathaway A class shares. Anyone want to take a guess at how much Berkshire Hathaway costs without cheating? Just a guess, right? Let's take a look at Berkshire Hathaway. Berkshire Hathaway, to own one share of stock in Berkshire Hathaway, is going to cost you $526,450. That's because they never did a stock split. They've never done a stock split. And we'll talk about why companies do stock splits. But Berkshire Hathaway has never done a stock split. This is the A class, okay? Now, you can still get some Berkshire Hathaway like me, but you want to get the B class. So I have B class Berkshire Hathaway, which is $346, right? That's $346. But it mirrors the A class. It's just that they've done stock splits with the B class, okay? Someone says, do they pay dividends? Right now, they're not paying any dividends. It says the 3.3% dividend yield, but they're not paying dividends, okay? Not paying dividends in Berkshire Hathaway, all right? So these are things that I think are important. You need to understand the economy. If the economy is down, I'm going to be looking at the Dollar General. I'm going to be looking at AutoZone, Pep Boys. I'm going to be looking at Walmart. I ain't even looking at Target, right? I'm looking at Walmart. I'm looking at, maybe if people are going over to Costco, I might be looking at Costco. Those are all companies from a cyclical standpoint that really do well when the economy starts to get soft. Okay. What's OTC? Now I know why people OTC. I don't know what OTC means. Other than over the counter. Other than over the counter, that's what I know OTC is. Okay. So cyclical stocks. All right. Let's keep going. Now, number 7 is going to be defense stocks. Now, when I first got started in the stock market, I used to think that defense stocks were like the military stocks, like Lockheed Martin and what's the other one that I did some work for them. I can't think of their name right now. Oh my goodness, I can't think of the company's name. Anyway, I used to think that that's what defense stocks were, but it's not. Here's what defense stocks are. These are companies that are resistant to economic cycles, meaning it doesn't matter whether the economy is good or bad, these companies are still going to do well. What companies are resistant to the economy? Type in the chat, what companies are resistant to the Raytheon is what I thought of distinct, General Dynamics. So the companies that are resistant is going to be, Terry says, grocery stores. So grocery stores would be your Costco's. Your grocery store would be your what's the one here in Georgia? You got Publix, you got Kroger. Those are going to be ones that are going to be resistant. Liquor stores, believe it or not, liquor companies, because people drink when they're happy and they drink when they're sad. Healthcare companies, exactly. You get sick, you got to go to the doctor, right? How about you got to fill up your car with gas? Gas station companies, right? You got to do that. Electric companies, you got to have some lights when you flip on the lights in your house. You got to have some gas to warm up your house. So these are what they call defense companies. These are going to be your Procter and Gamble, your cereal companies, anything that is sold inside the grocery store, which is normally Procter and Gamble. I can't even think of any others, but Hormel, any of your food companies, that General Mills, those companies, you're going to eat, regardless of whether the economy is doing bad or doing good. You still got to eat. Kellogg's, you still have to eat. So these are going to be defense stocks. These are stocks that it don't matter what the economy is doing, people are going to use those products and services for that defense stock. Okay. Now, why am I covering all of this and we're not jumping straight into how to trade in the market? Because you need to know this so that you can have great ideas and a great thought process before you even get to the market. I hope you guys understand why I'm tiptoeing you into this, because without understanding what we now know, you would make a mess of the stocks that you would choose. So you got to say, hey, what do I want? Do I want some income stocks? Do I want stocks that got growth potential? Am I cool with blue chip stocks? Maybe the economy is doing poorly and I'm not sure as to what company to get into. So maybe I'm going to go over here and find me some shelter in some of these defense companies, these defense stocks. See, now that you start to understand the categories and the classifications, now you can say, I'm going to invest in X, Y, and Z company. So Ms. Burke says, are there any stocks that fall into more than 3 stock categories? I don't know of any. I mean, I know of Microsoft falling into 3, but I don't know of any that fall into more than 3. There could be. I just don't know companies that would do that would fall into multiple categories. Okay. But these are some things that I want you to start thinking about as before you get out here and start trading stocks. You need to understand this so that you know the right type of stocks to purchase based on the economy, based on where you are in life. If you're young, I'm going to tell you to put a lot of money in growth stocks. Stocks like Uber, right? That's a growth company. They're not paying out dividends, but they're reinvesting their money. I may tell you as a young person, you might want to look at companies like Uber. You might want to look at companies the AI companies that are now popping up. You may want to look at some of those companies. It's going to be a little bit more riskier, but as a young person, you got time. You got time on your side. Whereas if you're my age, you definitely need to be over here with the blue chip. You need to be over here with some income stock companies. You need to be in some defensive companies because you ain't got time to get it wrong. See, when you're young, you got time to get it wrong and still can recover. But when you get to that point where you're getting ready to retire, you got to be in different types of stocks. That's why you can't sit here on the web and listen to all these so-called gurus who talking about I made 100% in 2 days, or I did this and I did that. They're taking some high risk. And you 1 foot from retirement. You can't listen to that joker. That joker 22 years old. He got time to screw up. So this is why it's important for you to understand the different categories and classifications, because while I may be investing in one set of stocks, somebody that's 25 years old, his portfolio is going to look totally different from mine. And it doesn't mean that he's right and I'm wrong, or I'm right and he's wrong. It just means that we're in different spaces in our lives. I hope that makes a whole lot of sense, and I hope that gives you an aha moment as it relates to different categories of stocks. All right, I'm about 11 minutes over. We are done with our classifications of stocks. Let's go ahead and stop our share here, and let's open up for any Q&A, any questions that you might have out there. So if you want to raise your hand, I'll open up the mic for your hand raise, or if you've got a question, you can drop a question in the Q&A or drop it in the chat.